disclaimer done. So,
Yeah.
all right. The opinions expressed in this presentation are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risks. This information is given in summary form and does not purport to be complete. While due care has been used in the preparation of this presentation, the information contained herein has been obtained from sources believed to be reliable. Its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside of Willow's control. Past performance is not a reliable indication of future performance.
Perfect. All
All
right,
right,
let's roll. I
jump
think
in.
we should go. Yeah.
Yep,
Risk
risk
metrics.
metrics. I don't know if there's anything you want to say on the curve. It looks to me like it's flattening a little bit. I mean, big moves from a year ago, that olive line down to the blue, down to the red line, and then
Yep.
from the red line to today is the blue line. The blue. Yeah.
Yeah. So flattening. So just so you know, usually a period of transition. Some very strange thing is never in the history of me working in this industry have I ever seen an inverted yield curve that didn't lead to a recession.
Yeah, and how long has it been inverted now? Like 2 years?
3 years, I think,
3 years?
2 or 3 years, never
Insane.
seen such a thing.
No.
And, but I do think it speaks to the amount of data that's not being reported properly. And as well, the fact that this is a bit different of an environment because I think we were more in a stagflationary environment. And
Mhm.
again, I think the people who have, they're doing fine, but the people who do not, they are suffering. So I think we have two classes of people. So we have a group that's absolutely in a recession and a group that's not. And
Mhm.
so, that bifurcation, I think there's no real good way to see this on the curve, but I think that's what that means. I mean, that's how,
It definitely, yeah, definitely speaks to making it wonky, right?
yeah,
That
yeah,
kind of dual
yeah,
environment just makes
totally.
data present
Yep,
oddly.
yep.
I thought this chart was interesting because it shows the change in the 10-year yield since the
Mhm.
Fed cut rates. So if they cut rates, you'd expect, right, yields come down. The 10-year has actually gone up almost 20% since they cut rates, and it's out
Mhm.
of the mean or the average of every time in the past that the Fed has cut rates. What has the
Yes,
10-year done in the following years? And you can see in the chart, it sort
exactly.
of follows this gray line here, or somewhere in that gray area, but we're in completely uncharted territory this time.
Yeah, so it brings us to question like, again, was it politically charged to lower interest rates? Look, if this doesn't matter if it's a Democrat or Republican who's an incumbent, we see this often.
Mhm.
Before election cycles, we see these types of moves. The other thing from Paul, in my perspective, and we want to put this out there that we think that the only reason they might have lowered rates is because they were concerned about some things that were happening in the financials. So basically what's happening in bonds and what's happening in the debt market, not necessarily because what worried us about this is that it will ignite more inflation. And we do think that that is already starting to show in some of the numbers, but let's take a look going forward.
Yeah.
Policy
Bonds,
error, Paul put policy error in there.
awesome.
I like the
Right.
title he put there because
Mhm.
is it a policy error? Meaning, is this going to ignite inflation going forward?
Right. Did they make the wrong choice?
Exactly.
We'll
This-
see as some more data
Yeah,
comes in, really.
yeah,
Bond spreads, not much to see here, still
yeah,
tightening, relatively flat. I found this chart interesting because the financials are that orange line, and there
yeah.
was a big risk of small
Uh-huh.
banks, and arguably a lot of those risks still exist because they really haven't been addressed, and deposits are still leaving into money market funds. That trend really hasn't stopped, but the perceived risk here has come down considerably. So I'm not entirely sure what that's signaling, that either the market's shrugging off those risks, saying, yeah, they're sort of existential and maybe not so real. So spreads are coming down as a result. I don't know. Do you have
Yeah.
any thoughts on that, Alexandra?
Yeah, no, I mean, I would say the same thing, Paul. I don't think that's anything. I mean,
Mhm,
I think the risks still remain out there with some of the credit, but like, we have to follow the data and
mhm.
spreads generally do not lie. So,
Yeah.
yeah.
And
So
they
I've never
say
seen
things
it
are
lie,
moving
to
in the
be honest with
direction. So,
I mean, the only thing I can think of is that there's more private debt than there is,
mhm,
market debt, but yeah. So,
mhm.
yeah.
All right. Credit default swap spreads, nothing to show here. Sovereigns, I think it was Brazil is going up slightly, and Mexico were the two that were sort of trending a little bit higher. But I mean, zooming out since 2008, right? It's really not notable. So low risk according to this of countries going belly up. Economic data. So leading economic index, this is from last month. We should get the new prints in a couple weeks. But
Mhm.
what's most important here is that it turned down. So you see that
Yeah.
it hit that red line all the way on the right, and now it's starting to go back down. Um,
So that red line is where, below that red line is recessionary,
mhm,
and that's what we're seeing here. And I think it's important, the next slide, Paul, if you want to advance to it, because the
mhm,
majority of, we don't have it. Okay. The majority of the leading economic indicators that were positive was because of one was the rate cut and B was the market, right?
mhm.
So not necessarily, yeah,
You're right.
significant. Oh, I really like this chart, by the
Yeah,
way.
I swapped this one out because I found it on the LEI index's site and was like, oh, I like this. Um,
Yeah.
but the other chart that Alexander was talking about is the components of the pieces that make up the leading economic
Yeah.
index, and the ones that were really pushing it to show a positive result were the market mostly. When you looked at the other components from new orders to manufacturing, all those things were negative influences on that number. Um, and then when you look at this tracker here that they have, it shows that there's sort of been fits and starts from contraction into recovery, but they have not been able to sustain. And so based on the past 12 months and the data that the leading economic index tracks, they say we're solidly in a contractionary phase, that the economy is contracting and not expanding. Um,
Mhm.
and this looks at the leading.
Yep. I would
The
have to
next one
say.
looks at
Hmm.
coincident indicators, which have been bouncing back and forth from slowdown to expansion, sort of indecision in a way, but unable to really hold in that expansion territory. So I think that speaks to sort of an aggregated view of some of the data that we look at. This just sort of shows like, yeah, lots of these data points are pointing to slowdown and contraction.
Slow down.
And,
Hmm.
yeah.
Hmm. And again, we argue that we're already in that for certain groups of people. No question about it. But yeah, it's not for the whole,
Mhm.
but for the groups.
All right. To
Let's
preface
see what
this
else we have.
next group of slides, it's going to look at energy prices, manufacturing, and just show that, one of the things we're really trying to track is how good is the economy? Is there growth? Is it growing? Is it strong? Is it resilient going forward? Or are we entering, or have we been in a sort of slowdown, contraction? It just sort of confirms a lot of the things we've been talking about. So while oil production is at new high, gasoline prices have come down, but they're still historically high.
Yeah, not,
So we're
yeah,
we're
not
producing
where they
more
were.
oil than we've ever produced before, and yet we're paying higher for gasoline, which it's like, wait a second.
I don't know, Paul, do you think that has something to do with our oil reserve or how much we're actually exporting to Europe because of the sanctions that were put in? Do we
I think
really?
those could all be
Yeah,
pieces of it,
yeah,
right? Or energy costs are inelastic, right? So
yeah.
like you need energy to do anything. So if the price goes up, you have to pay it
Mhm.
regardless. I
Yeah,
think there's some of that at play too, where
yeah,
companies
yeah.
realize, hey, we can milk this for a while too, so we'll keep these
So,
high.
so I
Um,
think it's really important to insert in here that obviously we are bipartisan when we look at how to manage your money, but we also have to recognize that there are certain areas that are going to be favored by different,
Mhm.
candidates. And of course, we think the energy sector is going to be one of the winners here, in particular, the domestic energy sector. And you do have master limited partnerships, MLPs in your portfolios, and they are up raging today. Because obviously this will trickle into their numbers. So we think
Yeah.
that's an area that's gonna do well.
Right. Energy should do well. And I think there's also a caveat that if we are really headed into this recessionary, contractionary period, it's a
Yeah.
negative force on energy, which you can sort of see here through the EIA's projections of diesel. And if you think about what diesel's used for, farm equipment, um, transportation, trucking, uh, what else uses diesel? So many components of our economy are tied to diesel for their energy. And the forecasts of these things over the next year or two are just going down, meaning that demand's shifting. And this is an interesting barometer of the economy because you can't fake this, right? I mean, you need energy in order to produce things, period. Um, Hey, I see your video.
Oh, you can see my video now.
Pop back in. Oh, that's great.
Awesome.
Yeah. So just something to be concerning is that some of this data is saying, okay, if diesel prices are going down, we look at world trade volume has really leveled off since the post-COVID recovery, but it's out of that trend line. That orange line there really is like this is the pre-COVID trend. And now we're significantly below it, meaning that world trade volumes have not really recovered or kept back up. Um,
Yep.
the next looks at global capital, non-defense capital goods shipments have really stalled out recently and are starting this sort of cresting period. I mean, will it recover from here? Looking at the chart historically, when it starts to turn like this, it usually goes into a really significant downturn.
Mhm.
So, I don't know. And you see that little red arrow at the bottom just showing the volume or rate of change has shifted negative.
And you
And
can
these
see,
are, yeah.
yeah, exactly. And you can see the red vertical bars are where there was a declared recession. So,
So it's a little worrisome, this chart, right?
yeah, this isn't
Um,
surprising though at all.
yeah.
And then manufacturing jobs, definitely going down, and the gap is getting wider. And these are
Yeah.
higher paying jobs, so that's definitely we'd like to have manufacturing jobs because they tend to be at the higher end of the pay scale.
Hmm. Right. And
So
you can see
I
that
don't,
trend just broke, right? I mean, it's this 2010 to 2020. It was a nice, consistent,
yep,
slow growth that these are good things you'd want to see. And then COVID hit and it just never recovered, never filled back up that gap. And it actually looks now, and it could go either way, but the latest data shows that it's really starting to roll over
into
even
it.
further. So
Yeah,
more concerning stuff.
exactly.
Um, Real quick on manufacturing backlogs. So like a bunch of orders come in and they can't process them all at once. So they have this backlog of orders. You can see after COVID or during COVID, there was this huge back order because all these things were piling up. And then they worked through them all. And then really since 2022, it's been flat. So the orders haven't been building up. At the same time, employment in this space has gone down. And when you look at who's cutting jobs, manufacturers all over the world are cutting jobs. I
Yeah,
just learned
exactly.
it
Yeah.
was a major. I just heard this morning as a major car component manufacturer in Germany cutting 6,000 jobs globally. And then you have the
Right,
guidance coming out.
Volkswagen. It's
Yeah,
Volkswagen.
yeah,
Yeah,
right. The guidance from all the
yeah,
different auto manufacturers coming
yeah.
out saying, hey, our inventory is piling up. Nobody's buying our cars. So we're going to start cutting our workforce. And so,
And part of that has to do with the bet on electric cars, so that I mean, I don't think the news isn't picking it up here, but it is picking it up in Belgium, where my husband's from. And it's talking about the fact that the demand for electric cars has fallen way down, and a lot of these companies made big bets in that direction.
Mhm.
So, yeah,
Yeah, and
there's
just
that.
anecdotally, the rates of electricity in Massachusetts, I just got a letter from Eversource
Yep,
saying they're raising them incredibly. And
20 to
so
30%.
right. So you think like, okay, I'm going to get this electric car and potentially save money and do something good. Well, guess what? Now all of a sudden you're paying more than you would have paid in gasoline for energy costs to charge it. And it kind of creates a situation where it's like, wait a second, like, let's get the infrastructure built first, then make this kind of transition. That's
Yeah,
just
I mean, this is, I think all of you know that I'm green oriented. Obviously, I live in a home that I don't have to pull from the grid, but you have to do this smart. You can't
Mhm.
just shove it on people. You have to
Mhm.
have, if you look, coal consumption is way up. And if you look now, they're bringing back nuclear facilities. Why? Because it's a cheap form of generation. So there's just, it has to be a more well thought out process around this whole thing.
Because it really is lower income earners who
Oh,
suffer the
yeah,
most under these types of
absolutely.
policies because
100%.
they already are the amount of their budget that needs to get spent on energy increases and they don't have that flexibility
Yeah.
to it has to come from somewhere else to make up for
Exactly. I
the
mean,
difference.
I'll explain something that did happen in Belgium. They have, rating from A to F, and they gave a certain period of time that if anyone was in the E and the F, they had to upgrade within 5 years or something like that. But we're talking 10, 20, $30,000, okay, for people to upgrade and even more to actually bring their homes to, I think they wanted everybody at a C or a B. And it's like, they had to retract that policy because they've loosened it because elderly people don't have that kind of money. They can't do that. And then
Right.
they get,
Fixed.
so
Yeah.
it does hit the lower income. It's,
Disproportionately affects
yeah,
elderly and low
yeah,
income.
yeah, not
It's
okay.
unfortunate.
Yeah, let's go.
And then
Job
job
growth.
growth, big downshift.
Yeah, yeah. This
And
is
net
not
monthly job
surprising.
growth has just been trending negative. So when you start to add all these things up together, lower job growth, these huge gaps from the trend in manufacturing and new orders and energy costs, it paints a picture that, wait a second, is our economy booming like some headlines we see say, or is something else going on? And so, I mean, our conclusion is that something
The
else is
price
definitely going
taking
on.
over, I think. Yeah. My feeling is we will ultimately end up paying the price, and I think the price we're paying right now is by way of higher prices.
Mhm.
But, let's hope it's not by a debt default or something like that, because there is that always in the back of my mind with
Right.
the amount of debt that we have in this environment.
Couple
Yeah.
couple interesting slides, just some good data. I had
Yeah.
no idea the numbers were this like there was this much of a gap between these two, but 86% of firms with revenues greater than $100 million are private and only 14% are public, which
Yeah.
just sort of blew my mind that there was
Yeah.
I assumed that the public would be much higher, but it's
And
not.
and yeah, and just so I knew that I knew that there were more private than public, but I didn't know this much. But
Yeah.
just keep in mind that I believe there's a concentration again. I mean, there are companies out there like Blackwater. I mean, there are companies out there that we don't even know that are making a ton of money on government contracts. On government contracts, a ton of government contracts to rebuild war-torn areas and things like that. So, this isn't something that we participate in your portfolio. We do, for, accredited investors will buy some private companies, but they're not liquid. And so a lot of our clients being in the older generation, these aren't necessarily, the private companies are not the place for most of
We
our
have
clients.
access to some of
We
these, but
do.
you're locking money up for
Yeah,
multiple years
we
at a
do.
time, or you only have very specific liquidity windows every 6 months or less.
Yeah,
So,
yeah.
um,
Okay,
yeah,
go.
look at this. So small cap, there's always a debate. Oh, is it time to put more money in small cap? I mean, today they're actually doing pretty good in response to something, but we'll see if that's a flash in the pan or if that's something else.
Did Didn't I say to you, Paul, like,
Yeah.
we saw an advisor moving out of small cap, and I looked at Paul, like they're moving out at the wrong time because seasonally,
Mm.
as we go into December and into January and part of February, small caps, that's the season for small caps. And then, but we don't like them at
Hmm.
this time, because a lot of the policies have not been favoring this group
Yeah,
at all.
especially from a fundamental level, this chart
Yeah,
shows of the 2,000 companies listed in the Russell Index, which is mostly small cap companies, 42% of them have negative earnings, meaning they're not making
exactly.
money. They're actually losing money. So
Yeah,
it's like, whoa.
yeah,
Compared to the S&P 500, we're only 6% of companies. So it's
exactly.
like talking about quality, where would you rather have your money?
Exactly.
Uh, Another interesting thing, it speaks sort of to that K-shape where there's a group of people who are doing great and a group of people who aren't. But you look at TSA checkpoint data and it says we're at records for people traveling. Um, so just an
Like
interesting
me.
data point.
I'm one of
Yes.
those statistics.
Um, Top 10 concentration, again, in the S&P 500. This is sort of a record level where the top 10 companies now make up about 35% of the total index. So 10 companies represent 35% of a 500 company index. It's a
Yeah.
pretty big chunk.
And if you take
But
those out of the market is up on those
mhm.
few that Paul spoke to, the market's up only 11% year to date. If you take those out, that's what you get. So it's
so,
not a
so
broad, like, again, these are not healthy trends. It's not a broad market, but that is definitely the case that if you take those out, markets only, it's pretty significant.
mhm. And it speaks to a long-term trend that Alexandra and I have been talking about since 2009 and probably even earlier, but than that
Yep.
of consolidation in the market where the big are just going to get bigger. And we've just seen that happen.
Yep. Yeah. I want to speak to these really quick too, because I think it's really important to note that that a lot of these companies right now, what Paul and I have to see, we own a few of them, so
Mhm.
but the way they're trading right now is that they're going to take a pause. And the good news is that some of the other sectors are performing better since what, July, Paul, August,
Yep.
right?
Yep.
And that's really good because it's a bit of a broadening. And so really since July, these have been actually underperforming. But still, when you look year to date, they were a big push to the performance in the market. Yeah, for the first part of the market. All right, where are we next?
What's next? Yep. Global
I
debt,
think
right? Everyone across the world, just debt, 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 debt fuel everything.
I love
US
it.
debt. I mean, look at that, straight up.
I love it.
And then these next three slides are interesting, right? They show the labor force participation rate compared to the U.S. birth rate, right? And so clearly birth rates are dropping. They're not, and it correlates very nicely with this available force. So that's an interesting piece. Shrinking labor force. So how do you make up that difference with debt? So this is labor force, and then on top of labor force participation is an it's a little complicated, but it's inverted debt to GDP. So if you were to
Exactly. Yeah,
match it up, it's basically saying that as this line goes down, more debt is incurred to make up for that loss
exactly.
of
Yeah,
workforce.
yeah.
Um, and then
So
how is that debt serviced? Through the debasement of our currency, right? So the Fed liquidity, meaning how much are they money printing? How much are they just injecting? Basically pushing a button and saying, oh yeah, here's an extra trillion here, here's an extra trillion there. Um, but it just shows that
yeah, just an extra
this is
trillion
how we're
here.
addressing this issue, right?
Yeah,
And so the question really becomes, how long can this go on for?
yeah.
And
I mean,
it
yeah.
can go on for
It,
years and years and years. But if we look to history, uh,
it's something I want to point to. Yeah, if you look to history, when you get this high, there is a lot of countries fall apart.
Yep. Every
But
empire in the past or in antiquity, when they started going crazy with their debt,
yeah,
those empires are no longer around.
no,
So,
I want to point to something here because you can see the 2008 on this. In that decade, if you remember, that was the Great Recession, if you will, and the financial crisis. And what we did, and this, I was very critical of this, and it's continuing, is we took the debt off the balance sheets of private industry, the publicly traded companies, essentially, and we put it squarely on the back of the federal government. That's you and me. That's higher taxes. And period, and also more debt. So you can see that big spike up, and it's only been going in this trajectory since. So the debt, it just continues to rise. We've taken it off the balance sheet of the private companies, and quite frankly, I think some of the private companies are in better shape than the US government. The only difference is we can print money, but printing money leads to more inflation. So this is all like you know,
a vicious
yeah,
cycle. Right?
a vicious cycle. Yeah. Okay. So let's rock and roll here.
Yeah, last chart and then some market charts. Just thought this was interesting looking at drought data in the US because it's been pretty dry up this way. Hasn't rained in a long time, but much of the country right now is in a drought. And so it's interesting to know, and then how will this play out? You can look at that other chart shows winter wheat is at record low levels or near record low levels too. So a trend we're keeping an eye on, see how this plays out. I mean, we could get a really wet December and all this changes, but we'll see.
Yeah. The good news is there was a lot of rain in California last year, so the reservoirs are definitely more full.
Nice.
So, but definitely the drought is hitting a lot of areas. Okay, so do we have question? Oh, we're going into market charts.
If you want, we can jump to questions if you'd rather.
I think maybe let's just talk about how we're positioned, Paul, because I think that's really important. Again, ahead of this election, or even that doesn't really necessarily have to do with that, but the head of the Fed actually lowering interest rates, we took a bigger position in utilities, which has been one of the best performing sectors so far this year, which is insane. But it's up there, and I can't remember exactly what it is, Paul, but it's pretty high. It's one of the best performing sectors.
It's done great.
Again, what's up?
It's done great.
It's done great. Yeah. Yeah. And then we're early in real estate investment trusts and REITs, but we like them. A few of them, like you do have, we have what, 2 or 3 now in the portfolio. We have 2 utilities in the portfolio. We also took some emerging markets. We bought early India, and we feel we've made our money. We've made quite a bit of money in India, and we're happy to be out because I think now we're being a consolidation period. But we still like the emerging markets. If any of you see today, crypto is raging today. We do have a position in virtually everybody's portfolio as a hedge, as we also have gold. Gold hit a new 52-week high. Now Bitcoin hit a new, all-time high today. Why is that? Because there's been talk. Now, again, this is talk, because until the rubber hits the road, I don't believe anything. But, on the campaign with Trump, they were talking about potentially, first of all, it's a very cryptocurrency friendly government, leader. So there's that, but then there's discussion about creating a Bitcoin reserve. Now, some countries are doing that right now. Some countries, this is why Paul and I took positions in gold, because there are a lot of countries across the globe, the central banks, that are buying gold and silver. And then now some are even doing Bitcoin, which they've been doing silently, quietly for a while. So you're there. Paul, did I miss anything let me look at our sectors.
Yeah, those are the main ones that we're focused on. There is some interesting movement, right? Like emerging economies and markets, like you mentioned. We're definitely doing a deeper dive there to see if there's any other opportunities. Some interesting things happening as the the smaller tech companies are
Mhm.
starting to bubble up and pop and show up on some of our screens. So
Yeah.
we're looking at that space. And then some of like I mean, I guess they are emerging market stuff, but like the global, I guess giants in their region. So like some of the companies we were looking at, well, I don't want to get into specifics, but similar to like the Amazons, but in different geographies that have sort of almost like a conglomerate approach, but have very good growth prospects and very good demographics to back them up.
Mhm.
Uh,
Yep.
yeah, and then and speaking of crypto too, there's so what is it? 13F is an SEC document that public companies, pension funds, all these different things are required to disclose once they hit a certain level of assets, so they can say here's the stuff that we own. And as more of these, I think they're reported quarterly, I think,
Mhm.
but each quarter, more and more institutions are starting to show that hey,
Plans.
they hold
Pension.
yeah, pension plans that they
Pension
hold
plans.
crypto or that they hold Bitcoin, that they hold
Yeah.
Ethereum. So that's
Yeah.
pretty wild to see. I think the latest
Mhm.
one was the state of Michigan's pension plan now owns a Ethereum and Bitcoin
It's the
position, which is
second
wild.
largest holder. Yeah.
Yeah,
Yeah.
wild.
Yeah.
So,
So, let's see. Do you have any questions? Because you can, if you do, you can raise your hand. So here's like, going forward, the way Paul and I say it is we're doing like a what we call barbell approach. You have a lot of very conservative. We're going to stick with the big companies for obvious reasons because we think they're the safest in this environment. That's what we prefer to own. We also own some of what they call the low beta. So the companies that don't have a lot of volatility, like the utilities, like the REITs. And what we like about those is it's giving us an income at the same time. And then the other piece is and this is what we call the barbell is that little crypto exposure, which we started, I think, at 2%, but it's gone up so much. I think, it's now what, at 5%. And we peel that back, just so you know, we don't just sit there. We peel it back so that we can lock in those gains for you. So anything to add there, Paul?
yeah, no, I think you nailed it.
Okay. All right, so I think we have no questions, and I don't think anybody wrote any questions in, right?
Let me just double check. I think there was one question around given the current environment that we're in, what are sort of like the safer areas to invest in? I think we've spoke to that.
Yeah,
Mhm,
utilities,
mhm,
REITs, we do have exposure to bonds for you.
mhm.
Um, utilities, REITs, we have some staples, but again, the largest companies, that's where we are right now.
Yeah.
Yeah. And we remember we let the data lead us, and the data was leading us here before, this election and everything. I mean, Paul and I, it became apparent in our work that Trump
Mhm.
was winning. We both predicted it because the way the market and individual sectors start to trade ahead of that. It's insane how, right, Paul? Like it's crazy how
As
it's just,
well.
yeah,
The
yeah.
charts, the charts, they tell you.
They
They
just they
telegraph
don't
what's going on.
lie. They don't lie, and especially when you see big money participate. That's the big point because that's what we follow is what's the big money doing. It's insane. It's kind of odd, but that's the art of our work.
And
So
if you have any other questions or something pops up, you know how to reach us. Feel free to shoot us an email, give us a call. Happy to chat.
gotcha. Okay. Have
All
a good
right.
one, everyone.
Thanks,
Take
everybody.
care.
Take care.
Ciao.